Basic appraisal principles, page 356. Amount plus interest is paid off when the borrower dies or when the property is sold. In recent years, reverse mortgages have become popular with elderly retired people. For example, Bertha Carter is 83. Her retirement income isn't quite enough to live on. She doesn't have many other assets, but she does have a wonderful old house that's completely paid for. Carter does not want to sell the house because she wants to spend the rest of her life there. Carter gives a lender a reverse mortgage. The lender pays her a specific sum of money every month. This amount supplements her income and allows her to keep living in her house. When Carter dies, her house will be sold. Out of the proceeds, the lender will be repaid the amount it loaned to Carter plus interest. Real estate lenders. The primary sources of capital for real estate loans include commercial banks, savings and loan associations, mortgage companies, large investors such as life insurance companies and pension funds, and real estate syndicates. Commercial banks. Commercial banks are the largest source of investment funds in the United States. As their name implies, they were traditionally oriented toward commercial lending, supplying capital for business ventures and construction projects on a comparatively short-term basis. While banks have continued to emphasize commercial loans, in recent years they have also become an important source of home mortgage loans. Savings and loan associations. Savings and loan associations, S&Ls, started out in the 19th century strictly as residential real estate lenders. Over the years, they carried on their original function, investing the majority of their assets in purchase loans for single-family homes. By the mid-1950s, they dominated local residential mortgage markets, becoming the nation's largest single source of funds for financing homes. In the 1980s, deregulation and economic factors led to the savings and loan crisis, in which hundreds of S&Ls became insolvent and had to be closed. As a result, S&Ls no longer dominate the residential finance market as they once did, but they are still a major source of home mortgages. Mortgage companies. Mortgage companies have been rapidly growing force in residential lending. Unlike banks and S&Ls, mortgage companies are not depository institutions. The loans they make to homeowners are generally made on behalf of large investors, such as life insurance companies and pension funds, or else immediately sold to an investor. Mortgage companies are sometimes called mortgage bankers. The term mortgage banker is often confused with a mortgage broker, but there is a distinction between them. Page 357. A mortgage broker simply negotiates loans, bringing borrowers together with lenders in exchange for a commission. Once the loan has been arranged, the mortgage broker's involvement ends. Mortgage brokers, on the other hand, originate loans on behalf of an investor and then service the loans, processing the borrower's payments until they are paid off. In exchange for servicing fees. Although mortgage companies may act as mortgage brokers, for the most part, they are mortgage bankers. Other investors. Life insurance companies, credit unions, and pension funds control vast amounts of capital in the form of insurance premiums, member deposits, and employer contributions to employee pensions. In addition to investing indirectly through mortgage companies, these large investors put money into income-producing real estate, such as office buildings, shopping centers, and industrial parks. In some cases, they make participation loans to real estate developers, receiving a percentage of the income generated by the development or a share in the developer's equity. Private investment syndicates, such as real estate limited partnerships and real estate investment trusts, also put a great deal of money into real estate. They often finance large residential developments and commercial projects. Conventional loans. The many different types of real estate loans that lending institutions make can all be placed in one of two main categories. Conventional loans or government-sponsored loans. A conventional loan is simply any institutional mortgage loan that isn't insured or guaranteed by government agency. Two examples of government-sponsored loans are FHA insured loans and VA guaranteed loans. In this chapter, we'll discuss various types of conventional loans and some common financing terminology. Package mortgages. Ordinarily, when you think of a loan used to purchase real estate, you assume that only the real estate is used to secure the loan. But occasionally, a lender will allow personal property items to be included as part of the security for the loan. When the value of certain personal property items, such as a refrigerator or clothes, washer and dryer, is added to the value of the real property, the maximum loan amount is increased. By packaging real and personal property into one mortgage, the borrower is able to finance the personal property items over a longer period at the mortgage interest rate, which is generally lower than the rate charged in a personal property loan transaction. If the borrower were to default on the mortgage, the personal property items would be included in any foreclosure proceedings. A package mortgage has disadvantages.